Debt Market Update, February 2021. The month of February 2021 was a volatile month for debt markets. 10-year G-Sec yields rose considerably during the month, driven by additional INR 800 billion market borrowings announced by the central government in February to March 2021 and considerably higher than expected fiscal deficit for FY22. The rise was exacerbated by increase in oil prices, higher US yields, and regular devolvement of government auctions by RBI, indicating muted demand for G-Secs. RBI tried to assuage the volatility by conducting OMOs, announcing Operation Twist, etc. The 10-year benchmark G-Sec yields ended the month at 6.23%, 32 basis points higher than last month. The spread between 10-year AAA rated corporate bond and 10-year G-Sec also widened during the month. The average net interbank liquidity surplus grew in the last month, supported by higher government spending, OMO purchases, foreign exchange purchases by RBI, and soft credit growth vis-a-vis deposit growth. However, with CRR set to increase to 3.5% from 3% of NDTL by end March 2021, liquidity should reduce by end of next month. FPI flows in debt markets have been weak in the current financial year. In February 2021, FPI sold net debt of $0.3 billion compared to approximately $0.7 billion in the last month. On a cumulative basis, in 11 MFY21, net FPI outflows from debt markets was $3.2 billion compared to net inflows of $2.1 billion during the same period last financial year. Outlook. In its MPC meeting held in February 2021, RBI left the policy repo rates and accommodative stance unchanged. The minutes of MPC meeting released later during the month noted the improvement in economic activity and showed concerns on core CPI being at elevated levels. It also highlighted upside risks to inflation and appeared mindful of the high system liquidity. However, MPC members felt that there is continued need for nurturing nascent growth and decided to leave the rates and stance unchanged. Since the last few months, multiple global and domestic developments have impacted the yields adversely. These include significant rise in crude prices and other major commodities, jump in 10-year US Treasury yields, rising concern of market that global inflation can surprise on upside, and consequently, US Fed can roll back policy measures sooner than expected. Further, adverse domestic developments like significantly higher than expected supply of market borrowings, relaxation of fiscal consolidation timeline by 3 years, rise in domestic fuel prices, concerns over rise in WPI and its trickle-down effect on CPI, etc. have also caused the G-Sec yields to rise. We expect that these factors will continue to impact G-Sec yields at least in the near term, and thus yields are likely to trade with an upward bias. Further, high SLR holding of PSU banks and signs of broad-based improvement in economic activity can also push yields higher. However, as has been the case over the past year or so, we believe RBI will continue to use conventional and unconventional tools going forward as well, thus limiting the increase in G-Sec yields. This was demonstrated in RBI conducting OMOs despite high system liquidity and allowing higher HTM limits for SLR investments done in FY22. Further, RBI has been proactively communicating that it will manage government borrowings in a non-disruptive manner and will ensure orderly evolution of the yield curve. The RBI governor also highlighted in the MPC minutes that normalization of CRR opens up space for a variety of market operations to inject additional liquidity, hinting at the possibility of further OMO purchases. These statements and actions of RBI should cap any significant rise in yields. Further, comfortable outlook on balance of payment and ample global liquidity also bode well for lower yields in India. In view of the above, we expect yields to trade with an upward bias, though the upside should be limited to a certain extent. The risk to this view is that the fiscal deficit turns out to be lower than anticipated due to lower expenditure and/or better than expected tax collections, along with lower inflation from Q2 FY22 onwards. Considering the above, we continue to recommend investment in short to medium duration debt funds, albeit in a staggered manner over a period of time depending on investors' risk appetite. While credit environment still warrants caution, opportunities exist in select pockets of non-AAA rated bonds as their spreads relative to AAA rated bonds are still trading at an attractive level. Hence, allocation to credit-oriented schemes or funds with some non-AAA exposure can be maintained or increased in a phased manner in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.